all Powell looks at when he gets all these questions about inflation, he always responds that, he wants to look at the prices and determine, why the prices are rising. Is it going to be transitory? It's hard to believe they're even using the word transitory again, but, is it going to stick? Or, he's all focused on prices, but prices going up are a result of inflation. You can't just focus on prices. It's like driving in the rear view, looking in the rear view mirror. You're going to get into an accident. It's the money supply expanding, which is continuing, and credit, right? Inflation is not just the expansion of the money supply. It's an expansion of credit, because credit can be used as money. You can buy stuff with credit even if you don't have any money, right? And so the more credit there is in the economy, the more upward pressure there is on prices. So you have to look at the money supply and the credit supply to know what's going to happen to prices in the future. If you're just looking at prices and you're ignoring all that, you're not going to fight inflation. And in fact, if you're saying, I'm going to wait until I see a sustained increase in prices before I do something about inflation, well, then you're too late. You have to be preemptive. You have to understand how the monetary aggregates are ultimately going to impact prices. There is a lag. That's why they say, don't let the inflation genie out of the bottle. By definition, if you do what Powell says he wants to do, wait until you see that prices are really going up, right? Looking through the impact of tariffs, because a lot of the discussion was, well, the tariffs, and how do you know if the price increases are a one-off event by the tariffs or if it's something more? And a lot of times too, when Powell talked about that inflation was a bit higher, he always attributed it to the tariffs or the fear of the tariffs. When prices were going up even before we had the tariff. But of course, he's trying to pre-blame any inflation on the tariffs. I mean, I know this was going to happen, right? Anything that happens, he's going to say, well, I guess it was the tariffs, right? That's how the Fed is going to deflect the blame from its own monetary policies and put them onto the tariffs. That's another reason why Trump shouldn't have done it, because it gives the Fed an excuse and it lets them off the hook, because it's very easy to blame the inflation on tariffs. But if Powell does what he says, just really waits until he can figure out whether the price increases are transitory or whether it's more permanent. By the time he figures that out, it's much too late to do anything about it, right? Because, the prices are really going. So his whole methodology of waiting for inflation to become a bigger problem before he tries to solve it means that, he can't solve it because of the lags. And of course, it doesn't even matter anyway. Inflation is already going to be much higher based on the mistakes that have already been made. The credit supply has been consistently growing throughout the entirety of the rate hike. And then, of course, the Fed stopped hiking. Money supply is growing. Now they are shrinking the balance sheet less, which is also going to end up being inflationary. And now the dollar is weakening. And one of the main reasons that the CPI retraced was the strength of the dollar. It was the dollar moving up that brought commodity prices down. Well, commodity prices are now rising, and they're going to rise even faster now that the dollar is falling. So the temporary effects of lower inflation are going to be gone. That's what was transitory. It was the dip in inflation that was transitory. That was a transitory decline in inflation. And now inflation is going to resume its acceleration, and it's going to be particularly fast because the Fed is not doing anything to put on the brakes. And in fact, the Fed is still planning on cutting rates. And again, that was also why I thought, and even the markets would probably agree, that this was dovish, in that Powell had to acknowledge that inflation was going to be higher. In fact, they increased their forecast for inflation this year from 2.5 to 2.8.
If you would have told me 10 years ago, heck, even 5 years ago, that gold would be trading over $3,000 and silver over $34 an ounce, and nobody in the mainstream media would be talking about it, I'd have said you were nuts. Absolutely no way. I mean, gold at $3,000? That used to be the number reserved for so-called gold bugs who were laughed off as fringe. And yet here we are. Gold has breached and closed above $3,000. Silver is climbing steadily, and the financial press is acting like it's just another Tuesday. There's no coverage on CNBC, no headlines in the Wall Street Journal, no panel discussions on Bloomberg asking, what does this mean? And that, my friends, is exactly the problem. It tells you everything you need to know about how deeply disconnected this market has become from reality. This is supposed to be the biggest story in the financial world, and it's being ignored. Why? Because gold is the mirror that exposes every lie they've told about inflation, interest rates, and monetary policy. It's not supposed to go up when the Fed says everything is under control. It's not supposed to rise when CPI is supposedly cooling, but it is. And it's rising for one reason, because nothing is under control. Gold doesn't lie. It's a truth serum in a sea of monetary propaganda. Let's go back in time for a minute. Gold first closed above $2,000 back in April of 2020, during the height of the COVID panic and the QE4 free-for-all. I remember the phones ringing off the hook at Schiff Gold, people scrambling to buy anything physical they could get their hands on. Premiums exploded. Delivery times were delayed. We were in the early stages of what I called at the time monetary madness. And what happened? Gold backed off. It corrected. The inflationistas breathed a sigh of relief. But they misunderstood what was coming. They thought it was just a panic move, but it wasn't. It was the tremor before the quake. Gold cooled down, but inflation didn't. And now here we are, 4 years later. And gold isn't just knocking on the $2,000 door. It's kicked it in and gone running through the hallway. And still, the mainstream refuses to see it for what it is. Now compare this to 2011. Remember when gold got up to $1,900 an ounce? Everyone lost their minds. Wall Street called it a bubble. The media gave it wall-to-wall coverage. They dragged out every analyst to explain how gold was a relic and how tech stocks were the future. Well, where are those analysts now? What are they saying with gold at $3,000? Nothing. Crickets. Because they're wrong again, and they can't admit it. The financial establishment has so much credibility tied to the dollar, to fiat currency, and to the lie that the Fed has everything under control that they can't afford to tell the truth about what gold is signaling. But the truth is self-evident. It's printed in 14-karat letters across every bullion chart on the planet. Gold is rising because the system is breaking. Simple as that. But here's where it gets even more interesting. The gold rally this time isn't being driven by retail investors. It's not mom and pop buying gold coins. They're too busy gambling on crypto or meme stocks, or worse, still trusting their 60-40 portfolio. No, this rally is being driven by the smartest, best capitalized players in the world. Central banks, the ultimate insiders of the fiat system. These aren't Reddit traders or YouTube influencers. These are the people who know exactly how the sausage gets made, and they don't want to eat it anymore. Central banks bought a record 1,136 tons of gold in 2022, then followed it up with more in 2023, and now we're seeing massive allocations again in 2024. China, India, Russia, Turkey, Brazil, they're all dumping dollars and scooping up gold like there's no tomorrow. Ask yourself, why would they do that if inflation was under control? Why would they choose an asset that pays zero yield over US Treasuries, paying 4.5%? Simple. Because they know those treasuries aren't worth the paper they're printed on. They'd rather hold something real, something with no counterparty risk, than trust the same broken Western financial system that has lied about inflation, monetized trillions in debt, and weaponized its own currency. And yet, with all of this going on, Fed Chair Jerome Powell doesn't get a single question about it. Not one. During the last press conference, Powell was asked about the stock market correction, about jobs, about wage growth, about the timing of potential rate cuts. But not a single journalist had the guts to ask, "Hey Jay, what do you think about gold at $3,000? You know why? Because the answer is radioactive. Because admitting what gold is saying would be to admit that Fed policy has been a disaster, that inflation is far from dead, that rate hikes didn't work, that QT didn't shrink the balance sheet fast enough, that real rates are still negative, and that faith in fiat is eroding by the day. Powell can dodge a question he's never asked, but he can't dodge the market forever. Eventually, the public catches on. Eventually, even the Wall Street Journal is going to have to run a cover story on gold, because it'll be at 4,000 or 5,000, and by then, the panic will be on. But by then, the smart money will have already moved in. the same way central banks have, the same way foreign governments have.
Nobody said to Powell, hey, what do you think about $3,000 gold? Because on Monday, gold closed above 3,000 for the first time ever. It closed above 3,000 again on Tuesday. And again today, it hit another record high. It closed at 3,048 and it's up again the evening, another $5. So as I'm recording this podcast live on Wednesday evening here in New York, or I'm not in New York, but New York time, gold is trading in the spot market at $3,053.30, up $5. Nobody brought this up because gold is flashing a warning that the Fed is too loose. You know, in the Q&A, one of the reporters brought up Alan Greenspan's old definition of price stability, where Greenspan said, well, price stability is where businesses and workers don't even bother to calculate price changes into their plans because prices are going up so slowly that nobody really cares, right? So it's like indifferent in decision making. And he asked Jerome Powell if he would ascribe to that definition and if he believes that we have price stability. And he did say, yes, I like that definition, but he really didn't answer as to whether or not he thought we had price stability, kind of dodged that. But the point I'm making in bringing it up is that Alan Greenspan also talked about the importance of gold in setting monetary policy. Alan Greenspan said that even though we're not officially on a gold standard, he said that he used the gold price as a reference, as a signal to let him know whether monetary policy was too tight or too easy. What Greenspan said was that if gold gets up to $400 an ounce, that means that he's too loose. If it goes below 300, that means he's too tight. So obviously at the time that Greenspan made the statement, gold was probably around $350 an ounce. And he kind of looked at, if it was going above 400, I'm too loose. Maybe we got to tighten policy. But if the price of gold drops below 300, maybe we're too tight, right? We got to ease up. Well, of course, gold's 3,000 now, right? So that shows you how much things have changed. I looked again at the chart going back to the beginning of this century. The S&P is actually down 60% if you price it in gold. I mean, that is an enormous bear market. And it really shows you that the entirety of the gain in the stock market is due to inflation. It's due to the destruction of the value of money, not a real increase in the value of the companies that are represented by the S&P 500, but that we are, measuring their value in rapidly depreciating currency. And it's not just the dollar relative to the euro or the yen or the pound, because all those currencies have gone down. And so it's a global inflation. It's not just an inflation in the United States.
What the gold market is screaming, what central bankers are acting on, but what the mainstream media and policymakers refuse to acknowledge, is that we are deep in the throes of a structural inflationary crisis, not a cyclical one. Gold at $3,000 isn't just a chart milestone. It's a flashing siren that the global monetary system, anchored to fiat currencies backed by nothing, is rapidly losing credibility. When gold trades above $3,000 and not a single mainstream outlet treats it as front-page news, we are living in a world so financially disconnected, so detached from reality, that it's as if the fire alarm is blaring and everyone is still sipping lattes and watching TikToks. And let's be real, Jerome Powell and his cronies at the Federal Reserve are either oblivious or pretending to be. While he's still obsessed with transitory inflation narratives and blaming tariffs or supply chains, the truth is that inflation is embedded deep within the structure of the economy. It's not an external storm passing through, it's termites in the foundation. And what's worse, they're using outdated tools, blindfolded by flawed economic models, to pretend they can fix it. Powell focuses on CPI data as if it's a crystal ball, ignoring the monetary roots of inflation, the reckless expansion of credit and the money supply that began long before the pandemic and accelerated during it. And now as inflation resurfaces, they're thinking about easing again? That's like pouring gasoline on a smoldering campfire and wondering why the forest just exploded into flames. Central banks around the world clearly see what's coming. Why else are they dumping US treasuries and accumulating record amounts of gold? These are not gold bugs on Reddit. They're the insiders of the global financial system. They know that U.S. debt is unpayable, and they don't want to be the last ones holding the bag. In 2024 alone, central banks added more than 1,200 tons of gold to their reserves. China alone has publicly disclosed the purchase of over 600 tons, and that's just what they admit. Realistically, they're buying even more through backdoor channels, quietly swapping dollars for bullion, while the West argues about rate cuts and inflation targets that haven't meant anything since the 1990s. The U.S. is losing control of the global financial narrative, and the rise of physical gold holdings by countries like Russia, India, Turkey, and the Gulf states marks a massive pivot away from dollar hegemony. And yet, while central banks rearm with gold, Wall Street is still selling to chase the next AI startup. The public, trained to see gold as an archaic relic and Bitcoin as a futuristic revolution, is missing the biggest wealth transfer of the decade. Gold isn't just a hedge anymore. It's becoming the anchor of a new financial order. That brings me to silver. If gold is the king of money, silver is its twin brother with a rocket strapped to his back. Historically, silver always lags gold slightly in the early phases of a bull market, then it explodes higher. We saw it in the 1970s, and we saw it again in 2010 to 2011. The silver-to-gold ratio, which now sits at over 85-1, is absurd by historical standards. A ratio of 40-1 would already mean silver at $75 if gold is at $3,000. That's not a prediction, it's simple math. The only reason silver hasn't joined the party yet is because central banks don't buy it, and retail investors still don't get it. But silver is not just money, it's industrial and strategic. It's in every solar panel, every EV, every high-end weapon system, every 5G tower. As the global push for green energy and digital infrastructure intensifies, silver's industrial demand will skyrocket. And while the U.S. Mint is struggling to source blanks and the LBMA is seeing physical silver inventories plunge, prices remain ridiculously undervalued. That's not just a disconnect, that's a once-in-a-generation opportunity for investors who understand the game. And let's be honest, physical silver is one of the few assets left that's both cheap and real. You can't print it, you can't fake it, and when the public realizes what's happening, the price will reprice violently to reflect reality. What makes this moment even more absurd is the silence of the Fed. Alan Greenspan, back when central banking still had a sliver of discipline, used gold as a signal. He openly said that when gold moved above $400, it meant policy was too loose. Well, what does $3,000 tell us, Chairman Powell? That your policy is working? It means that the credibility of the US dollar is collapsing in slow motion. And what's terrifying is that nobody in the press room even asked him about it. Not one reporter thought to mention the fact that gold had hit multiple all-time highs in 1 week. That tells you everything you need to know about how disconnected the financial establishment has become. It's a clown show of groupthink, and the only people who are seeing clearly are those who are stepping outside the system, buying real assets, ditching fiat, and refusing to play the central banking shell game. Now let's talk about what this means for the average investor. If you're still holding 60% equities and 40% bonds because that's what your retirement advisor told you back in 2005, you're walking into a buzzsaw. The S&P is up in nominal terms, but when priced in gold, it's been in a bear market for over a decade. That's the reality. Your dollar-based returns are meaningless if the purchasing power of those dollars is falling faster than your portfolio is growing. Bonds are toast. Treasuries are the new junk bonds. Only instead of promising high returns, they guarantee losses after inflation. And cash? Don't even get me started. The Fed is actively devaluing the dollar, and inflation is back on the upswing. The temporary dip in CPI was just that, temporary. Commodity prices are rising again, shipping costs are up, and the Fed is cornered. They can't raise rates without blowing up the economy, and they can't cut without igniting even worse inflation. That's a lose-lose scenario for savers. Meanwhile, mining stocks remain the most underowned, undervalued segment of the entire market. These companies literally dig gold and silver out of the ground and are trading at price-to-earnings ratios that make 2008 look like a party. And yet, nobody wants them. But when gold explodes to $4,000, and it will, And when silver doubles or triples from here, those mining stocks are going to go parabolic. We're talking about 10x, 20x moves. Yes, they're volatile. Yes, they're cyclical. But if you want asymmetric upside, that's where it is. And while the tech darlings of the NASDAQ are falling from grace, and while real estate investors wake up to 8% mortgages and stagnant rents, the smart money is going into hard assets, tangible production, and stores of value that can't be destroyed with a keystroke. So here's the bottom line. Gold at $3,000 is not a top. It's a signal. It's the starter's pistol for a new monetary race. And if you're still standing on the sidelines wondering if now is the right time to buy, you're already late. But you're not too late. This is the early innings of a massive global repricing event. Central banks know it. Insiders know it. And now you know it. Don't be the last one to move. Buy gold. Buy silver. And for those of you who have the risk appetite and the patience, buy the miners. Because when this story goes mainstream, when CNBC finally wakes up and admits that gold is telling the truth about the dollar, the window of opportunity will slam shut. You want to be holding the real thing before that happens, not chasing the crowd after.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.